March 2023. Wall Street analysts are having a field day. NVIDIA, the company that makes gaming chips for nerds playing Fortnite, just announced they're going all in on artificial intelligence. Goldman Sachs publishes a note. Niche player in an overcrowded market. Morgan Stanley's tech team literally laughs during their earnings call review. Intel CEO Brian Krzanich smirking in an interview. We've been doing AI chips for years. They're late to the party. Even NVIDIA's own shareholders are nervous. The stock wobbles. But Jensen Huang, NVIDIA CEO who refuses to wear anything but a black leather jacket, just smiled. Because he knew something they didn't. 24 months later, NVIDIA doesn't just make money. They print it faster than the U.S. Treasury. $130 billion in revenue. In one fiscal year. Here's what Wall Street missed. NVIDIA wasn't just making gaming chips. They'd spent 10 years building the only chip architecture that could handle AI training at scale. While Intel focused on CPUs and everyone else chased mobile phones, NVIDIA quietly created a monopoly. Their GPUs turned out to be the perfect architecture for AI math. Not good, not competitive, perfect. Every single major AI company, OpenAI, Google, Meta, Microsoft, needs NVIDIA chips to train their models. Not want, need. Let me show you how insane this money printer is. Fiscal 2025 revenue, $130.5 billion. That's up 114% from the year before. But here's the kicker, their profit margin, 53.7%. For every dollar NVIDIA makes, they keep 53 cents. For context, Apple's profit margin, 25%, Amazon, 6%, Walmart, 2.4%. NVIDIA is literally printing money at rates that make oil companies jealous. Now here's where it gets brutal. Remember those competitors who laughed? Intel tried to build competing AI chips. They're 3 years behind and losing billions. Even NVIDIA's customers tried to build their own chips. Amazon, Microsoft, Meta all build custom silicon, and they are all still buying NVIDIA. Why? Because NVIDIA's software ecosystem, CUDA, has a 15-year head start. Switching costs are so high that even trillion-dollar companies can't escape. Here's the harsh truth Wall Street refuses to admit. They didn't just miss NVIDIA's growth. They fundamentally misunderstood what a monopoly looks like in the AI age. Jensen Huang didn't build a chip company. He built a profit printing machine with a moat so wide, even his customers can't swim across it. The leather jacket wasn't a quirky CEO flex. It was a power move. Oh, and that $20 billion acquisition of Grok in late 2025? That's NVIDIA buying the one startup that could have threatened them, paid in cash. Because when you're printing $72 billion in annual profit, $20 billion is just Thursday. Wall Street analysts are now scrambling to upgrade their price targets. Meanwhile, Jensen's wearing the same leather jacket, and NVIDIA's chips still sold out for the next 18 months. Demand's so crazy, they literally cannot make them fast enough. That's not a chip company. That's a money printer with a semiconductor label. The companies that Wall Street mocks today might be the money printers of tomorrow. The question is, are you paying attention to the leather jacket CEOs or listening to the analysts who missed a $130 billion run?